Hey guys, in this video, I'm going to talk to you about how billionaire, entrepreneur, and philanthropist T Boone Pickens organized a donation of over $250 million, which is $250 million. So I'm going to share with you kind of how it all fell apart, the math behind the gift, the controversy behind it, the lawsuit, and lastly, I'm going to just share with you kind of the craziest part I think about this whole ordeal. Now, this thing he put together, that he called it the gift of a lifetime. But let me just kind of give you a backstory on T Boone Pickens. First of all, I got the idea for this video when I was listening to his book on audiobook, obviously, called The First Billion is the Hardest. And he really just talks about all the things he's overcome in life to get to where he was. It's a really good story. He talks about how, he even though his first book is called The Luckiest Person Alive or something like that, he talks about just everything he overcame, all the bad luck he had, all the wrong investments he had to get to where he is. And so it's really good. It's kind of motivational if you're an entrepreneur, because sometimes you're just going to have to overcome all these things. So anyways, back to this story. First of all, a year before, he gave $165 million to OSU Athletics, which at the time was the single largest donation to a college. And actually, the next year he gave he gave an additional amount to the I can't think of the word right now. Academics department. Sorry, as you can tell, I didn't go to college, or I didn't finish college. But anyways. Around that time frame, early 2007, he went and had his doctor's check at a medical center, and they said to him, well, we've got good news, we've got bad news. He said, the good news is you're going to live to be 114. The bad news, you won't be able to hear or see. But they just gave him a really excellent health report, and he just got the crazy idea that he would put together this thing because what he realized, he would qualify for a lower interest or lower rate on his life insurance. And he's like, I bet there's other people like me. So they contacted a bunch of donors of the OSU alumni, and and at the end they found about 28, 27, something like that, because he says 28 in his book. I found online it says 27, so maybe he was the 28th. Roughly 25, 28 season ticket holders. They invited them all to a dinner. Some of them were season ticket holders, some of them were donors, but they're all OSU alumni, which is Oklahoma State University, if you don't know. And they were all healthy, and they were all within 65 to 85 years of age. And so what they did is they had to pass a physical. And like I said, it was for life insurance policy, which they all called the gift of a lifetime. And what it was going to do is each person was going to be insured for $10 million. And the average premium on that, and this is reported, like I said, none of this stuff is public information, so it's just reported by different agencies. But anyway, they said it was going to be $357,000 per person per year. That was going to be paid by OSU, and obviously they were going to be the beneficiaries of it. And just to kind of simplify everything, I know millions and hundreds of thousands is kind of hard to do the math in your head. So we're just going to take away the last three zeros on both of those. So if you put it in simple terms, it's basically a $10,000 policy, and it's going to cost them $357 a year. So I did the math on just the numbers, and it was going to break even at 28 years. So basically, one person had to die in order every year. Otherwise, it wasn't gonna self-implode. We'll talk about more of that later. But each time somebody died, the fund would get $10 million. And so, but also keep in mind, as the people die, it's going to be less and less premium. So in Boone's mind, according to the book, the university was going to net about $200 million on this deal, even after premiums paid and everything else. But but before we get into that, I kind of want to break down some more of the math. Because you may be thinking right now, well, what would it cost for me to have a $10 million policy? Or, what would happen if they were younger alumni? Or, let's do some of the math on that, because there's tons of sub niche products out right now that somebody at that age could sell their life insurance policy. There's tons of different things that are new products that are available. But like for instance, like if I were to buy I'm 39 years old right now. If I were to buy a 30-year term, which wouldn't have the whole life benefits, it would only cost me $11,000 a year for a $10 million policy. But if I were to get a guaranteed universal life, which is another word for a whole life policy, without any bells and whistles of being attached to an index fund or anything like that, that would cost me $60,000 a year. So big difference between $60,000 and $357,000. But the backlash, all the controversy came from when, for instance, Lionel Raff, he was their Regents professor. He said it's totally inappropriate for an organization to be betting how long its alumni will live. Well, when you put it that way, it does kind of sound kind of morbid, but they all had good hearts. They all had good intentions. Even T Boone Pickens was talking about how people were crying that they would be able to donate so much money to their school when they die, because most people would only dream of donating $10 million to the school you went to college to. You know what I'm trying to say. But anyways, also there was some controversy in the legality of the insurance policy. At the time, it was a loophole they found where an organization could put policies on people and pay for it. You could, I think Walmart got in trouble for that at the time, but at that time they called it peasant insurance, which basically, and that may have been where he got the idea from, but at the time Walmart had small policies on multiple employees, and they were obviously not the beneficiaries, and some of those employees ended up passing away without life insurance. So that might have been where he got the idea. I'm not sure, but in this case, it was a much bigger policy, $10 million policy. But like I said, the whole program came to an end in 2010, and in February 2010, OSU and Lincoln National, which is the company that was the life insurance company that wrote the policies, they actually sued each other. And actually in 2012, the law, or whatever you want to call it, the courts favored Lincoln National to be able to keep all the money which was at the time $33 million in premium, because obviously they tried to cancel 3 years after the policy was in place, and they tried to say since they didn't actually get the policies till a month later, they should be allowed to cancel it. But basically the judge said no, you had plenty of time to look at the policies in the first 3 years. But and what OSU was trying to say in this case was that some of the numbers didn't line up, whatever it was. But at the end of the day, that the policy or the program was canceled. But like I said, the craziest thing about this whole ordeal to me is that Boone was obviously never an insurance agent or anything to do with the insurance industry. I don't know where he got this idea. I'd love to pick his brain. Obviously, he's passed away, but I'd love to hear how he came to this idea. I just think that's so crazy to me as an insurance agent. But the thing is, he had previous experience with insurance for his employees. He had similar packages. He mentioned it one time in the book how he included life insurance as part of their benefits package. He didn't really go into the details. It could be buy-sell agreements. I mean, there's tons of ways that you could get tax deferred benefits to your employees through life insurance. But I don't want to make this video a 25-minute video or 2-hour video, but there's tons of ways to do it, and that's what I think was so cool about it. I also was kind of wondering, I wonder if they, were they max funding the policies? Because, like I said, they all had above average health. So what I think is what he was doing is just max funding the policies to maximize their money, so it also grows, and so they're not losing money. And that's how I think he got to that $200 million in positive equity by that. And also, for all we know, he could have been doing a premium finance on it to leverage their money. So we don't know all the details. I would really, really love to know their details. So if you're the insurance agent that wrote that policy, I would love to know the details. I'm sure you made a ton of money. I'm sure you're not working anymore. You may be, actually, because they canceled. But anyways, there's tons of stuff that I would love to know about this policy. But like I said, it's not very, there's not a lot of information on it. I had to go to about 5 or 6 different pages just to get this information, including Wikipedia. I went on like ESPN. I went on like a couple OSU pages, but tons of good stuff out there. But it just goes to show you guys, if millionaires and billionaires are using the benefits of life insurance to donate to their alum, to the school they graduated from, isn't it something that you should have in place for your friends, for your family, for your church, for any organization? I mean, just think about it. There are some companies and some policies that you can actually write in your the school you want to donate to, or your charity you want to donate to, your church you want to donate to, into the life insurance policy. And I even know of one that matches that amount up to, like, I think it's 100,000. I should have researched it before I made this video, but I think it's like 1% or 100,000, whichever is greatest. I don't remember. If you'd like to know that amount, message me and comment on this video, or anything you'd like to learn about this video, comment and I'll try to find out for you. All right, but thanks for watching. All right, bye.